Wagner here. Just about 10:30 in Honolulu, 4:30 in New York on Tuesday, 11th day of February 2014, and this is the daily report for gold and silver. Yellen has spoke, and we have a higher stock market as well as a higher precious metals markets morning today. We'll talk about this dramatic rise that we're witnessing in gold throughout the show. Suffice it to say, we really saw it start in Hong Kong. To the board, 1290 approximately, current print on the screen. High 94.60, we're just off the highs. Low 75.70 on the day. Silver is trading higher, actually up almost 0.62%. The high 2038, the low 1986, the current above 20 at 1916. But as you can see, we have not seen any kind of breakout above these series of tops here still. We'll talk about silver a little bit more towards the end of the show. Interesting series of events as we watch this market, these higher prices kind of unfold. Let's go ahead and blow this up, and you can see as the market closes yesterday, we pretty much get a flat line, roughly trading at about 1275 up to about 1278. As the market moved from Australia to Hong Kong, though, we got this dramatic rise in the market. This was in Hong Kong, and then the market kind of stabilized. And before Yellen spoke, we saw it come back and dip, go back to these lows. But what she said was construed as bullish not only for the equities markets, but for gold, as we saw the market rise, hit these new sets of highs roughly at 1290. And as we can easily see, it's now forming a base. We've got this period of consolidation. Very, very typical for a market that's moving up, because what we will see in essence when we slow everything down is market going sideways for a little while, you spike up, then it consolidates for a little bit, you get your spike up, and then another level of consolidation. And I think that that's what we're seeing as this market kind of moves towards 1300. We'll talk about resistance points in a second. So traders, even though it's nominal, I do believe that we might in fact have our first little level of resistance. I believe that it will be able to break through this level, but you'll get a period of consolidation, might take a couple of tries. If you take a look at this top at about 1294, and in fact, this is that secondary top that we used for our fib retracement. You can see that by virtue of the fact that this is at 100%, so 100 and 0 are starting and ending points. When we look at the market, it's quite clear that we're currently just below, I should say, this particular top at 1294. We've managed to break through this top pretty effectively, and this is the top right in here that we're going to look to trail our stops just behind. We'll send out a special trade alert for that, but we'll want to put them underneath these particular highs right here. In case we do have the market backing down, we can lock in some profits. And my suggestion in terms of stop placement is we have the lowest levels that we have are around 1267, so you can probably place your stop at 1265. For my aggressive traders that got in at 58, we're getting out with a little profit should the market come back down and hit you there. At the same time, for our traders that got in a little bit higher, it would be roughly a push to a dollar profit, dollar loss, depending on where you got in. But that is probably what I'm going to suggest. Traders, you can go act at your own discretion. That is where I would trail my stop up to. We can absolutely see that we've got this one level right here that's providing a little bit of resistance, but we'll have to see what kind of follow through we're getting, because we got a pretty aggressive market over in Asia last night, and especially Hong Kong. New Year's is over, and it does seem as though they are buying the precious yellow metal again. So we talked about this a little bit the other day. These are different resistance levels that we could in fact run into. Most interesting, most noteworthy, we have effectively traded well above this particular level, which is at 1280, about 1280, call it, and we're substantially above it, currently trading at about 1289. When we look at our tops, this is that one top that I pointed out as a potential resistance point. That's right in here. I've drawn it a little bit above so you can see the candles, but we're effectively at that point. And our next real level of resistance is going to be, of course, the century mark. As it breaks through 1300, it's going to be a century mark that it's either going to barrel through there or it might find some resistance. But I do see a level of resistance again at around 1309. Now realize that when I talk about levels of resistance, if the market is in an upward track, it's going to break through these levels, but it will do that in a stair-step manner. You can see we talked about the fact that we had these rather nice spikes followed by shallow corrections, spikes, shallow corrections all the way up. A little bit different in terms of the action today. Half a day chart that we're looking at, and it kind of just barreled straight up and straight through this 1280 former resistance area that I now believe could in fact become support. Now we have been using this particular daily chart recently because it's got a set of channels in it, and those channels allow us to effectively look at the market as it moves down or moves up. But rather than a parallel or perpendicular line, we've got these at an angle, and the tact of the angle has been the current direction, which has been down in the market. Of course, we have seen a couple of substantial rallies. Again, this is our daily chart, and our next real level of resistance right in here would be to follow this slope down. You can see that it did find resistance at this particular high. When it hit this high, this is back, of course, October of last year, we really didn't see it reach this line. In fact, it stalled just above there. We have really strong support on this particular channel line. That's our 61% channel line. Effectively, if we're getting into a real rally here, we shouldn't have any problems breaking through this 23% retracement line. Now, we've pulled out, this is a 3-day chart. This has our current Elliott wave count. I do believe that we really have the opportunity right now to have re-entered some sort of a bullish phase of the market, even if the market is still in a bear count. And we'll talk about that in a second, because there's a couple of ways we can look at this. We can effectively see the fact that by any stretch of the imagination, we have crossed into that positive territory. We have, in fact, broken above that line. And according to this chart, the $1,300 point, 1302, 1300 is going to be the next level on this 3-day chart. So traders, last chart for gold on today's show, and I'm going to set forth yet another model. It's a much more of a macro view of the market. The first thing is, of course, we can see our clear breakout even on this particular chart right in here, as we look at this long-standing resistance line. And the fact is, the market has gone through there. But here's what I want you to consider, and that is actually the major count itself. Now, just as in Russian dolls, when we take a look at a 5 count on a bull Elliott wave count, 1, 2, 3, 4, and 5, that all this set of 5 waves will make up a major. We're going to just for now call this a major first. If this is the major first, then what we're going to look at is a major second. And here's what's interesting. Even in a bull market, your correction for wave 2 could in fact go to as low as 61%. And we met that criteria because here's our 61% retracement at 1161. We've fallen shy of that. So could we then maybe see this as a long A, a B, and then we have this long C coming in? How we would make sense of it in terms of our macro right here is going to be interesting, because we then get that one big rally. This is the rally we got last year, of course, to 1435, and then the market comes down. But my point of this entire exercise is that if we qualify this whole move as a move up and a major first, and we look at all of this as a major second, we could still actually go back into a bull count. And that's my point. There's no doubt we've been utilizing this bear count on the way down. It's been a bear market. But just in terms of a macro view, when we really stand back, the fact that we've hit this double bottom and the fact that that double bottom came above a 61% retracement of this entire move really allows us to look at that as a macro model. And I find that very interesting because what the distinction between the two is as follows. If in fact we are truly in our bear count as we have been looking at, and the market has been in a bear market, then what we should witness here is some sort of an A, a B, and a C. However, after that A, B, and a C, we're going to return to 1, 2, 3, 4, 5. In other words, in a bear count, after this corrective or counter trend period, we're going to move back down. However, if in fact what this was some sort of an A, B, C down here, then it changes everything, because then what we're looking for is our impulse, and our impulse is 5 waves to the upside. Now, how are we going to know? Well, we'll know somewhere around here for certain if in fact we get the market moving back down and moving back down hard. In other words, an ABC, and then we move back down hard. But it is something that I believe is absolutely noteworthy. And the fact that when we stand back and we look at the fact that it falls within the parameters of a good Elliott wave model, meaning we get a 61% retracement following a major 5 count up, and the retracement is 61, that would be a typical wave 2. Wave 4 of our counter waves on a bull count tends to be a little bit more shallow, typically anywhere between 23 and 38%, whereas your second wave tends to be the deepest of the two counter waves and can go as deep. I've seen it go to 78 on rare occasion, but you will find that typically it will go to the 61% retracement level. And for that reason, for your consideration, we want to look at that as a potential macro model. And then lastly, I want to take a quick look at silver. As you know, we have been sidelined. We have not taken a position. When we took a position in gold, we did not take one in silver. My sense is I'd rather have you double up on gold personally than go a little bit gold and a little bit silver. And the rationale behind it is as follows. We've got this real strong band of resistance that comes in around 2029 to 2050. It hasn't been able to break above that. We also have real strong support trading just below 19 to about 1900 an ounce. And between these two, we can see that for the better part of the last 2 months, two and a half months, it has just been wound. This is a weekly chart within the highs and the lows of this trading range. Unless it really breaks above this particular point right here, I am not a buyer there, because my sense is every time it's moved to that point, it's backed off. So for that reason, my suggestion is for those that trade both, double up on the gold. For those that are trading silver, consider trading gold. I believe that you'll get a better return on your dollars, and that's why I suggested that all traders get long gold when we did. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.